This is how the buyers are looking at the business. Very simple formula. There's about 32 different methods that you can value the business. None of those methods is of any use to buyer. This is how they look at it. They said, okay, I've got a profit, and profit is $100,000. I'm going to multiply this profit by something, and I'll show you what that something is in a second, and that's my value. And that's how they all look at it. Everything else is irrelevant. Well, it does have small relevance, but profit and that multiplies how they calculate the business value. So what's a profit? So a profit is not what you got on your tax return on the bottom, all right? So every accountant in the room is going to say to you that they always work as hard as they can to bring that profit as close to zero as possible. And look, these are legitimate tax deductions, and your final tax lodgement, it doesn't reflect your business, but it's a document that's prepared for the tax department for the purposes of estimating your tax of your taxable income. So it's not a true reflection of your business. So what we need to do is we need to look at this. These are the main points. There's more. So we're going to look at the profit that shows on the bottom of that tax return, and then we're going to add to that any once-off. So for example, I don't know, you spend $20,000 on putting a new carpet into your office, and you won't have to do that for the next 20 years. We're going to look at any paper expenses such as amortization or depreciation. We're going to put them back in the profit. Owner's personal expenses, which is borderline should it be, but what they put as a personal expense. I'll give you an example. Let's say you got a company car, and company car costs you $70,000 a year because you got a brand new Merc, but you can actually do the same job for Hyundai. So the difference you can actually add back into the profits. Owner's wages get added back into the profits. The owner's wages that you paid to yourself, this is very important. And then we take out of it owner's market wage. And why do we do this? Because your tax return or any financial statements, or you may going to choose to pay yourself only $50,000 a year because it suits your tax position, but the fair market wage for you should be $150,000. It could work opposite. You could be paying yourself $250,000 for the wage, but for the position that you're having in the business, you should pay yourself $100,000. So it needs to be adjusted. Now the question is, why are we looking for the profit after the owner's wage, not profit including owner's wage? So you'll see that later on a little bit more. But the reason is this, because if I'm a buyer and I'm buying your business, I'm giving up my potential earning that I can earn in a job. So if I've got a job of $100,000, I'm giving that up. So I didn't buy myself $300,000 profit, but I bought myself $300,000 profit less what I could earn somewhere else. So you're looking at a profit over and above what you can earn by exchanging your time for money.